If you're still saving, don't get me wrong, inject that into further purchases because it's going to help your cash flow. The factors that you want to analyze to pick an area prime for growth. And if you can pick an area before it really starts to gentrify, what typically will happen is you're probably going to be competing with less people. Properties are $1 million. So many areas that had a bad stigma back in the day and now just completely changed, gentrified and grown in value. And we know that scarcity drives growth. So really understanding that supply and demand issue always is going to help pick that area prime for growth. So if we look at median days on market as an average 12 months ago versus today, that gives us an understanding of demand. It's not uncommon for properties to go 20, 30, 40, 50, and that's a good indication of the demand in a marketplace. Go out there, make sure you're following a strategy, a structure, and getting those areas primed for growth. Sooner you can get those areas primed for growth, you're getting that capital growth, you're creating that equity, and that equity you can now access to purchase another property and another property and another property. We are live with another episode of the Tailored Property Wealth Podcast. My name is Casey Taylor. I'm the host of the podcast. And in today's episode, we are talking about the factors that you want to analyze to pick an area prime for growth. So this one's super important if you want to go out there, purchase a property, get the results you're after, to build your wealth, get closer to financial freedom. Cash flow alone will not make you financially free. A lot of people chase cash flow, but capital growth is where it's at because you're able to get that capital growth, leverage into further properties, and continue to grow that wealth base. And that really does come back to understanding those fundamentals to pick that area prime for growth. So let's get into it. Okay. I've managed to build a multi-million-dollar property portfolio in just a few short years, and I want to inspire and motivate other Australians that if I can do it, so can you. The Tailored Property Wealth Podcast has been created to help educate, mentor, coach, and support you through everything relating to property investing to make sure you go out there and make a much better educated decision when investing in property. Please like, share, subscribe, and share this podcast with anyone who you think might see value in it. Alrighty, so here are some of the factors that we're going to go through in today's episode. Average income versus median value, which is your affordability. Gentrification, building approvals, population growth, infrastructure spending, median days on market, average vendor discount, and sales volume. All right, so let's just get straight into it and start to talk about average income versus median value, aka affordability. So when we're kind of looking at areas, we want to understand past growth because sometimes we can see that those markets are a little bit overcooked or they've gone on that massive run. And then there's other markets that are more affordable in comparison to those markets that have gone on a run. Prime example, Sydney and Melbourne, even Newcastle where I reside, and roughly it kind of follows Sydney. It is more of a market on its own now. However, those markets typically go first within the cycle. So that's where we see Sydney and Melbourne do well. But then affordability starts to become a factor. And then that's where some of these other marketplaces we're seeing perform at the moment really start to do their thing. Brisbane, Adelaide, Perth. We've touched on Brisbane taking over Melbourne. However, there's still affordability there, still in comparison to Sydney, for example. So if we're then analysing the average income of those areas, and we understand that there's strong income in those areas, yet the median value of property in that area is significantly lower than what people can afford. What that means is that because of that higher income, people can actually borrow more money to allow those prices to push higher. And because a lot of the time when we're investing, people are getting finance, it does come back to what people can borrow. All right. So not everyone's going out there purchasing with cash. Sure, there are people out there doing that, and it's not then reliant on lending, but a big component of that is the lending. So if we're looking then at, for example, Sydney and since the onset of COVID, as per Core Logic, I think Sydney's only done about 20 something percent. Melbourne's only done like 10 or 11%. And that's because of an affordability piece there. So it's really important to understand that. And because price points are a lot higher, they're a lot closer to their borrowing capacity ceiling. And because of that, then we see rates go up and it even reduces that borrowing capacity ceiling. So if we can target those areas specifically that are more affordable, where we know average income is strong, there's that capacity to push prices higher purely from a borrowing capacity point of view. All right, so that's a super, super crucial one to take a look at. You want to analyze average income on an individual suburb level, on a local government area level as well. Sometimes you can pick neighbouring suburbs that haven't gone on that growth run yet, and it will push them higher because of those neighbouring suburbs that have already gone on that run in some areas. Even in a suburb selection point of view, there's more affordable suburbs. Next one is gentrification. And this just naturally happens over time. And if you can kind of pick an area before it really starts to gentrify, what typically will happen is you're probably going to be competing with less people, because not everyone's onto that spot, because it's before that gentrification happens. A lot of local government areas invest in the gentrification over time. As things start to improve, more people want to move to the area. It's more appealing to families, it's more appealing to first homeowners, and it just pushes that demand for people to move to those areas. So that gentrification piece is super, super important. And what will happen over time is, because of the gentrification, as prices push higher and rents push higher, it does kind of push out some of, I guess, the people in the area that can't now afford to purchase their like lower socioeconomic. So the area just naturally has this kind of domino effect with that gentrification piece, and naturally over time it changes. And there's examples everywhere. Newcastle, your Mayfield, your Carrington, long time ago they weren't popular areas. They're now super popular. Properties are $1 million. It's the same in Sydney. So many areas that had a bad stigma back in the day and now just completely changed, gentrified, and grown in value. So that's a super important one to look at. If you can get in right before that gentrification piece happens, and then you just allow time to do its thing, it's super, super valuable. All right. Thank you for listening to this episode of the Tailored Property Wealth Podcast. I hope you're learning lots and getting lots of value out of this episode. If you want to discuss the opportunity of working with us here at Tailored Property Wealth, jump across to the website www.tailoredpropertywealth.com.au, complete the contact form, let us know that you're listening to the Tailored Property Wealth Podcast, and let's reach out, let's have a chat and see how we can help you execute on your property goals. Building approvals. Talk about this one a lot, and this is, like we always mention, simply a supply and demand issue, all right? If we understand that building approvals are not high in an area, there's a lack of supply keeping up with the demand of areas, especially, for example, when we look at those metro locations, okay? So if we can analyze if it's low supply levels or we can analyze if it's high supply levels, we know that there might be a risk if there is high supply coming to a marketplace, because that's going to stagnate growth, versus understanding a marketplace with a limited supply, because it's going to help with that scarcity piece, and we know that scarcity drives growth. Same on the flip side, population growth, that is increased demand or potentially lower demand. All right. So if we can understand that as well for a particular area, then we can understand that demand's increasing, but supply is actually decreasing, or it's just simply not keeping up with that demand. It's scarcity, pressure cooker for growth, and prices drive higher. So really understanding that supply and demand issue always is going to help pick that area prime for growth. Overarching within the country, I've talked about it before, we simply have a supply and demand issue at the moment. That supply issue even if it is addressed and those numbers are starting to be hit that we need, it's still going to take many years for that to really start to take effect. But we're simply not keeping up with the supply that we need from a building approval point of view, and then the builds itself being completed. So the rental crisis isn't going anywhere. The supply and demand issue and the pressure cooker for growth isn't going anywhere anytime soon. So if you really understand those values, it's going to be exciting for you as an investor. Infrastructure spending. All right, this kind of leads into gentrification for one. So because in areas investing in the infrastructure spending, more people want to move to the area, right? Because there's more amenities. But then it's also creating jobs for those amenities to be built from a construction point of view, et cetera, et cetera, et cetera. So then it then leads back into population growth, because over time, naturally, that increases. So some of these, I guess, data points lead into other data points, and it is that positive for growth. All right. So that's some of kind of the overarching things you can look at for growth, and then there's some really key ones to understand on a suburb point of view, and a local government area point of view. And the first one is median days on market, and this is something that we follow closely and gives you a really good understanding of the demand in an area. So if we look at median days on market as an average 12 months ago versus today, that gives us an understanding of demand. And that is because, let's say 12 months ago, the median days on market was 30 days. So on average, taking 30 days to sell a property versus now it's 15 days. So the average time it's taken to sell a property in that local government area or suburb has halved. And that shows that because demand's increasing, properties are selling faster. So that's something that we follow closely. Sometimes it might just kind of sit flat. It might be 15 days now, 12 months ago. So still selling extremely fast, still showcasing that demand is strong and that demand is there. And what you can also do to kind of measure this one as well, if you're going to open homes and there's 30 groups there, you just have to think that there's 30 people out actively looking for property, and this is one property that's going to be sold. There's now still potentially 29 other buyers out there that are still looking for property. So still massive demand. And look, some of those might just be window shoppers or whatever it is, but even if it's 80% of those people going through are still actively looking, you can see that demand's strong, and it gives you the confidence that people are going to continue to be buying and soaking up that supply. Average vendor discount is another one to keep track of. This one can kind of fluctuate a little bit, so I don't take it for gospel, and you kind of use it in conjunction with the median days on market. And that is the average vendor discount. So when the vendor first lists that property for sale, what that price point is, and then what it ultimately sells for. And the reason sometimes this can be skewed is vendors, they know an area is hot, so they're going to try and run the gauntlet. They're going to try and put that property higher than it's actually worth in the marketplace. And naturally, sometimes what happens is if it's listed for 600, market value is genuinely 550, the market starts to talk and they're only getting offers at 550 and naturally have to sell below that list price. And that's because the vendor was greedy. They weren't realistic on that price, and that's where that median days on market comes into play and can sometimes be a little bit off. But if it's that area that is really in demand, median days on market's low, there's 30 people getting through an open home every single weekend. It's not uncommon for properties to go 20, 30, 40, 50. Honestly, we've seen stuff go 100K over at the moment, the list price. So they just completely blow out, and that's a good indication of the demand in a marketplace. Then again, on the flip side of that, we have agents that will strategically list under where market value is because they're trying to generate leads. They get more people in their database that they can call and blah, blah, blah. So it is a little bit skewed, I guess. But if we couple that back in with that median days on market, we can kind of see some correlation. Sales volume. Sales volume is another one. What can happen, and vacancy rates kind of lead into this one as well, right? I've spoken about this before. Vacancy rates are the precursor for growth because what will happen, vacancy rates are low. There's a lot of renters out there that don't actually, like they might have deposits or whatever in their circumstances. They're currently just renting at the moment. But then they start to get sick of one, no stock, or two, rental income increasing, and rents might not be as affordable as the mortgage repayments. So they'll go out there and purchase property. They increase demand because there's more people competing, there's more sales volume, blah, blah, blah. So it's that snowball effect, right? So they're two important things to look at as well. That is kind of some of the core things that you want to understand when you're going out there and doing your research on areas prime for growth. You don't want to go out there and just start looking at property in your hometown or where you currently reside because it might not be the best place for you to purchase and get that capital growth that's going to build your wealth base and create that financial freedom for you. All right. It is something where you have to follow a process. You have to stick to that process. Property investing is all a game of numbers. It's not just buying this sexy looking house that's in a shitty area, in a shitty town. All right. Go out there, make sure you're following a strategy, a structure, and getting those areas prime for growth, because the sooner you can get those areas prime for growth, you're getting that capital growth, you're creating that equity, and that equity you can now access to purchase another property and another property and another property. It's that domino effect. And then all of a sudden, you don't have to save for a deposit. And it's super powerful to building a portfolio and building a portfolio fast. If you're still saving, don't get me wrong, inject that into further purchases because it's going to help your cash flow. And if you can delay your gratification and just continue to have those cash buffers, it's going to serve you really, really well. But you want to get that capital growth. So don't go just chasing cash flow in these super regional locations or these people that are pushing units and all this nonsense, small dollar value. They're just trying to pump out transactions. It's not genuinely going to, I guess, help you. It's there's some people out there, unfortunately, that are just trying to make a dollar. So just think about those things. Cool, guys. Thank you for listening to the episode. That's about wrapped up. Make sure you go out there. If you're doing this yourself, take a look at these factors. Make sure you're understanding them, and you will get that area prime for growth. Thanks for listening, and we'll see you on the next episode. Bye. Thank you for listening to this episode of the podcast. If you don't already, make sure you follow us across all of our social platforms. That can be Instagram, YouTube, LinkedIn, Facebook. I wish you all the best out there on your property investing journey, and I hope each decision you make in purchasing more property gets you closer to your goal of financial freedom.